Hi Dharmo, thank you for joining us today. We have seen how the first 3 quarters of 2022 has been very challenging for investors. But in the last quarter, we have seen moderating inflation coming back. We have seen China's reopening as well. So how have our portfolios actually performed in the fourth quarter?
Well, what we saw was strong financial market performance in fourth quarter. As the fear of inflation fades, investors basically start pricing in slower rate hikes from central banks. And also because the reversal of COVID restriction in China that boosted investors' sentiment towards Asian equities, and that also had spillover effect on the rest of the world. So overall, most portfolios did relatively well. We were down somewhere between 0.6 to up 2.2% for the quarter. And what we saw was that the moderate to aggressive portfolios actually performed better because they participated more in the equity rebound. Whereas on the fixed income side, although the fixed income delivered small positive return, the weakening of the US dollar actually ate into that, and therefore there was a slight drag in terms of the performances of the fixed income portfolio.
Thank you, Dharmo, for giving us a brief explanation in terms of how the portfolios have performed. So with that in mind, could you also share with us whether is it our portfolio allocations have contributed positively to our performance of the portfolios, or even to the underperformance of the portfolios as well?
Well, I think we participated in the Asian recovery. Most of the portfolios would have exposure to Asian equities, and that has boosted the performance. I think that's probably on the positive side. But if we look back, what we've done was that in the last quarter, because of the huge volatility in Asian markets, we've sort of constrained that exposure a bit. As well, on the other hand, we did allocate a bit to Europe, and that sort of contributed positively as well for some of the portfolios, whereas the US equities sort of slightly underperformed the rest of the world.
So with that, do you think there will be any further changes going to the portfolios in this quarter as well?
Well, given that equity markets have done very well in the last couple of months and the current market volatility, what we've done is actually we will be cutting the equity exposure for most portfolios. This is also in line with our house view of going overweight fixed income, as we think that bonds have actually priced in most of the rate hikes and probably would perform relatively well going from here. Whereas the outlook for equities are probably a little bit more uncertain. That depends on whether we have a deep recession or not. And given that wide spectrum of possibilities, and as a result, the expected volatility, we've actually reduced risk for most portfolios. However, except for the most aggressive portfolios, what we've done is we've allocated the fixed income portion to Asian high yield. That's really the most aggressive part of the fixed income spectrum. And we believe that this can actually deliver almost equity-like returns for investors.
I guess we have a better picture of how our portfolios are working towards 2023. So what kind of advice will you be giving to our investors going into this new year?
Well, given the double-digit sell-off in equities and bonds last year, our study shows that actually the longer-term expected return for all asset classes have actually gone up. So which means that we think that it's a good time to invest today, albeit that there'll be probably greater volatility in the next several months. Right? So our recommendation is for investors to really look more in the long term and basically stay invested, and if possible, even dollar average your portfolio to meet your long-term investment objective.
Thank you, Dharmo, for joining us today. Really appreciate it.
Thanks for having me, Raja.